So I think you'll have had a lot of exciting sessions. You'll have learned from life planning to mid-cap stocks to peer-to-peer lending. I think I'm going to come back to the one thing that we all can't avoid, which is taxes. And let me try to give you a financial planning perspective to it, because I think a lot of us just kind of do taxes because we have to. And we're also happy that it gets extended to 31st August. We get one more month. And then it's 4 days to go and everyone's kind of saying, oh, I got to do it again. So let me just give you a sense on how you can integrate your tax planning strategy with your financial plan and your money life, essentially. So I think there are a bunch of things that all of us can control. There are tax rates which none of us can control. And I think we need to think through that very, very carefully. I think I can see in the audience a set of people who probably are very young, certainly much younger than I am, and a set of people who probably will be looking for some retirement-oriented solutions as well. So I'm going to cover both of them during this session. Let me just start off with a bit of income structuring. I think one of the advantages that we've had as we've moved to a more responsive HR organization for most people is that there is some flexibility in terms of how you can actually structure your compensation. And I think most people are just so excited about leaving their last employer. Good riddance to, you know what. And they just kind of go out and keep negotiating the next salary without spending a lot of time on understanding structure. And I think that's really, really important for people to do differently. So let's just talk about probably what's the biggest opportunity available for people to structure their income better. And this didn't exist till a couple of years back. This is using the NPS, the National Pension System. It gets talked about a lot, but the number of people who still have an NPS account, I don't know if we can get people to raise their hand here. How many people here have an NPS account? Okay, that's good. That's about 20% of the audience probably. How many of y'all have employers contributing to that? Okay, so that's like down to 2-3%. Okay, so this is actually the gap that I'm referring to. Typically what happens is there is a section available where you can actually get your employer to contribute 10% of your basic NDA combination to the NPS directly. Now, if they contribute on directly and you don't do that, then that money actually becomes tax saved for you. At this point in time, the NPS is taxable on maturity, but that's fine. You're deferring taxes out to maybe 20 years later, 30 years later. So you're getting the benefit of compounding all of that. A lot of companies actually now offer this. We tell a lot of people who are in senior enough positions to actually influence this process, to also tell their employers to look at this very seriously, because it's a great way to actually save tax beyond the Section 80C, which gets used up very, very quickly by most people. So if you're salaried, here's an opportunity, 10% of basic plus TA. It aligns perfectly with your retirement plan. You don't need all of your money for short-term needs. Use this opportunity. If you're self-employed as well, you can also take advantage of the same opportunity. The number there is 20%. So for a lot of self-employed people who don't actually plan for retirement because it always seems like their business is going to give them the best rate of return, and they keep kind of rolling their money out in business, I think here's a great opportunity for them to save tax. One of the other things, of course, you will realize is that because it's relatively new, people and tax advisors talk a lot more about PPF than NPS. And all of us, I think for most people who are in the audience here and who are fairly money savvy, you probably know PPF accounts since you're 12 years old or maybe 10 years old. But the NPS is only 2 years, 2 years in the making as far as this tax section is concerned. The other advantage, of course, is that you can also make your own contribution up to 50,000 rupees as a deduction. So in effect, you can take a combination of the 10% that your employer contributes and a 50,000 rupees benefit which is available to combine together to make this a fairly tax efficient option for yourself. The beauty about the NPS is that, like I mentioned, it's tax deferred, but I think what you also need to understand is it allows you to take equity exposure. And therefore, what happens is for a lot of people who have a lot of time to go towards their retirement, they can take the benefit of compounding of equities. Just at the end of this month, the limit for NPS contribution to equities has got raised to 75%. So it was earlier 50%. I think a lot of younger people kind of found that as a disadvantage. But if you're kind of looking at it very seriously, you can go all the way up to 75% for this. And last but not the least is the fact that you can actually save cost, because the cost on the NPS continues to be one of the most attractive. Clearly, the advantage here is you get a tax deferment. On top of that, you get a low cost, so you get the ability to compound over many years. And I think ultimately, if you're looking out at a retirement 20, 30, 15 years later, you will have to believe that tax laws will change. Today, I think a lot of reasons why people don't buy the NPS is because of the annuitization and the fact that there is going to be a tax which is necessarily going to have to be paid on a portion at maturity. And there are maybe other products where there is a tax exemption today. What you have to really go out and think is, 15 years later, will our governments all over the world have more money than what they have today, or will they have less? If you go by past experience, it's not likely. So we think that tax is going to become at par for everything. So don't miss this opportunity to combine your retirement planning with an NPS solution. Let me move to a second thing which comes to us very regularly. A lot of people have financial goals that they're planning for, right? We spoke about the PPF. A lot of young people are told that when you start working, open your PPF account first. It's a great place, 15 years, let it compound, try to max, do all of that. The question that you really have to ask yourself is that, what are my end objectives with my money? A lot of younger people actually want to go and study again, maybe 3, 4, 5 years down the line. The challenge is that the PPF is not very flexible for withdrawals. What if you want to actually go out and look at something where you want to set up your own business? You need capital for that. Obviously, you can go to a P2P lender, but if you aren't going there, the alternative is your own savings. And the reality is that your PPF is not going to give you the money there. So I think you have to put your financial goals first, use the product later. Even if the product is great, it doesn't matter. Let me give you a few more examples. Let's look at endowment policies, money-back policies, right? I think for most people in the audience here, they know that those are not necessarily the most favored products. The question really is that if you are going to end up trying to save tax under Section 80C, do you have any visibility on how much of saving you need under that same section 1 year from today, 2 years from today, 4 years from today, 6 years from today, 8 years from today? Your incomes keep going to grow. Your income's hopefully going to be growing. You're going to have larger contributions happening. You might have a house that you buy. You'll have a bunch of things happening along the way. So why would you go out and commit to something for the next 15, 20 years to save tax if all you're trying to do is solve a problem for this year? And that's why we tell investors that avoid doing anything of this kind. It may feel like a fill it, shut it, forget it solution, but unfortunately your needs change. The third thing is buying a house, right? It's a big favorite. All of us love it. On top of that, you have tax benefits. We wrote a lot of analysis around this, and ultimately we've always concluded one thing, that when you take a home loan at 9% or 8.5% or 10%, depending on who your lender is, and you save, say, 30% tax, you still pay between 6 and 7% on your loan at the beginning. So it's not free money. At the end of the day, there's still money to be paid back. And one of the biggest things that we're seeing today is the need for flexibility in your financial plan, because jobs are getting less certain. You might want to become an entrepreneur. All of these things mean that buying and taking a house or a home loan just because of the tax break probably to us seems too much of a commitment to make over 20 years. I think there are phases in your life when you can look at it, but what we really worry about is a lot of people who are 25 come to us and tell us, you know what, I'm going to buy a house. And why do you want to do that? Because it gives me a tax break. That can't be the reason why you want to buy a house. You buy a house for a bunch of other reasons. The tax break is like a topping on that process. The last thing, and of course there were a lot of questions around health insurance, and I'll talk to you a little bit about the numbers on the next slide. But we do see a lot of people come back to us about buying health insurance because of Section 80D benefits. And of course, critical illness also gets covered there. So people want to buy health insurance to get the tax break. I have a very interesting case that came to us where there was a client of ours who's in his early 70s, no health insurance, not well enough to be able to get one, obviously at that age. He had an offering come by in his club where, because there was a group insurance cover that was getting created, he was offered with a 1-year waiting period, which is not particularly bad because he was healthy, the ability to buy a health insurance cover going all the way up to 30 lakhs if he wanted. So I told him it's a great product. I think you should go ahead with it. I think we need this in your portfolio. It's a gap that exists. He said, fine. 2 months later, we met him again. So we asked him, is the insurance all done? So he said, yes, I went to sign the papers, but I didn't take it on. And I said, why? And he said, you know what? Group insurance covers don't get Section 80D benefits. And I said, oh my goodness. Why on earth didn't you call me about this one? Right? So this is actually the challenge, because what happens is tax actually precedes the financial plan in a lot of these processes. And what ends up therefore happening is you end up getting very suboptimal covers. If you look at some of the data here, and this is just very real data around India, you'll typically find that inflation on medical expenses right now reported is about 11.3%. Effectively, it means that you're doubling your medical costs every 6.5 years, which essentially means that if you have a 5 lakh cover today, by the time 20 years have passed, you'll need 40 lakhs for the same cost, right? That's huge. The challenge is that you have a tax benefit available for 25 to 30,000 rupees of premium. If you cover your senior citizen parents, then you can get another 30,000 bucks. And everyone's working within that framework to try to figure out what kind of health cover to buy. Really bad idea. I think you need to look at these kind of charts to figure out how much insurance you need. Then look at the fact that you get a health cover on top of it. You get a tax benefit on top of it to a certain extent maybe, and just go ahead and do that. Let's move to portfolio structuring. Again, we see a lot of people come to us saying, I want to buy this product because I've heard a lot of good things about it. The challenge is that the people that they're hearing these good things from could appear in a completely different tax slab. So one of the things that we struggle with getting answers from most of the time when we meet people afresh is if you ask them the question saying, what's your tax slab? Most of them are clueless. First of all, there is no 10% tax slab anymore. Most people tell us we are in the 10% tax slab. We're like, okay, it doesn't exist. There's either a 5 or a 20. So what happens is that imagine that you're taking investment decisions without knowing your tax slab. Take an example of a tax-free bond. Is it a good product? Maybe, maybe not. If you're in the highest tax bracket, very efficient. If you're in a low tax bracket, you're probably better off in a fixed deposit. The question is, do you know your tax slab? And are you planning your investment strategy basis your tax slab? Number 2, you can actually use different kinds of products to actually manage your taxes a little better. So how you can do this is that you have different kind of rates on different kinds of sources of income. So salary or business is obviously taxed at a different rate depending on how much you earn. A lot of this obviously appears and disappears from your Form 16 in whatever way it is. You have interest income, which typically gets taxed at your slab rate depending on where you are. You have dividend income, which gets taxed very differently. It also gets taxed differently depending on the source of the dividend income. It also gets taxed differently depending on the amount of the dividend income that you get. Some of it also gets taxed at source. Some of it gets, because it becomes a DDT, some of it gets taxed when it comes in your hand. So you need to understand that there's a bunch of complexities because we like to make things more complex because it helps. So there's a bunch of things that you need to know around the fact that dividends can appear differently to different people. Capital gains, obviously everyone knows long term, everyone knows short term, but you'll see the complexity in the next slide. And then there's rental income, which can be taxed differently. So depending on how you are structured, your sources of income may need to vary. because you might find one source of income more efficient for you, depending on your tax slab. So that tax slab actually drives a lot of your choices as far as your portfolio is concerned. Let me move to capital gains. So the one question that comes to us very often is everyone believes long term is equal to 1 year. The reality is it's not. It depends on what you're buying. So capital gains is equal to 3 years for debt. It's equal to 2 years for real estate now. It's equal to 1 year for equity. And there are a bunch of other products along the way, which are combinations of different things, which could be anywhere between 1 and 3 years. So first of all, the definition of long term, just like when people ask you whether large cap and small cap definitions of long term are the same or not, the same way, I think even for tax, you need to look at the fact that definitions are different. And people tend to confuse this quite a lot. The second thing that we all need to understand very carefully is the grandfathering clause that came in the budget this year. So a lot of people have not spent a lot of time trying to understand that today, even though equity markets may be at an all-time high, a lot of the stocks, or in fact a large part of mutual funds as well, are actually quoting at NAVs which may be very close to or below their Jan 31st prices. So if they want to make exit decisions, not because of tax, but because of other reasons, and they're holding back because they worry that now there is a 10% tax, I think you need to go back and look at comparing the prices as on Jan 31 to decide on whether you're actually going to be taxable or not. And remember, this is only impacting equities. This has no impact on debt at all. We have a whole bunch of people who come to us saying, I'm now not going to sell my debt funds because it is taxable. Hello, it was always taxable. It was taxable for the last 3 years, nothing has changed. What you also need to do is you need to look at how you can take benefits of indexation and the benefits of inflation happening. I think indexation is highly underestimated as a powerful tool. As long as you've had inflation high, which was the case for a large number of years, and hopefully we're not getting into that again, you would find that if you were able to get a capital gains benefit with an indexation built in, you could find that your tax rates were effectively anywhere between 3 to 10%. Even with the way the indexation rates are now getting declared, when someone tells you you're getting 20% with indexation, our estimates is your effective tax rate is going to be anywhere between 11 and 12%. So that's still very, very attractive, considering that a lot of your income is coming in at 30%, 35% at this point in time. The second bit that you need to be careful about is to use capital gains benefits only when you actually need what you're going to do. And real estate is a classical case. You can save some tax by buying another house if you sell a property and invest it within a certain period of time. So we see a whole bunch of people sell one property and buy another one simply because of tax. That can't be the reason. You buy the house or you buy that second property because you need it. You buy that second property because it has a role to play in your life, which you think is very important. It cannot be the tax driving it. The tax is a good thing that it happens, but I don't think that's the reason why you ever buy something of that kind. Lastly, you need to understand that the same product can be efficient at one point and inefficient at another point. And I'm just going to talk about budget 2018 just from a simple perspective. One of the reasons why people never bought international mutual funds in India is, first of all, because India is a growth story. Unfortunately, the US has grown faster than India has in terms of equity markets, certainly. But the other big reason was that it was taxed as debt. And people said, you know what, Indian equity, zero tax, hold for 1 year. If I buy an international fund, 3 years, like debt, 20% with indexation. Guess what's happened? Now you have 10% tax on local investments as well. If you take 20% with indexation and your rate is 11, 12%, then all of a sudden, that geographical diversification that is so critical that all financial planners talk to you about is very relevant. And if you go out and look at the data, you'll now suddenly see that many parts of the world have actually outperformed India as well. So if you've been leaving out international products from your portfolio because of taxation, I think there's a big story that you need to take advantage of. In the same way, the balanced fund industry picked up a whole lot of money in 2017 on the back of some great returns and zero tax. The reality is that tax has come in, tax is now at 10%. So if you thought balance funds were attractive in 2017, frankly, we've never been big believers in them. We like it separate and simple. But having said that, we think balance funds have become less attractive, internationals become more attractive. Does that mean your portfolio strategy needs to change? Probably. But your portfolio strategy cannot run basis tax. And I'm just on the last slide. I can imagine that I'm a little over. This is just for anyone who's thinking about retirement beyond the NPS. And what we've done here is we've just tried to put out a set of alternatives that people look at when they plan their retirement cash flows. The first thing in there is annuities. The second is interest income. The third is systematic withdrawal plans. They become a lot more popular. And the fourth is dividend income from mutual funds again. So while I think most people in the audience will know what is what, I'll spend time on just the systematic withdrawal plan because it probably has a role to play for most people in their portfolios, even if they don't want to use it for retirement. One of the things that clearly does tend to happen is SIPs have become very popular. There are a bunch of people now who believe that SIPs are the way to go. And we think it's a great disciplined way to save money, though it's not a separate product. The problem is that when you want to exit, you have the same issue. You start to time the market. Okay, right now valuations are too much. I think we should come out of all our money. We do all of these things at that particular point. The issue is that if you didn't know how to time your market entry in, then how do you know how to time your market entry out? It seems strange to us that everyone kind of believes the in is possible, but the in is not possible, but the out is possible. The reality is we think it's not possible for both ways. And therefore, when you want to finally get to the point where you want to pull money out of your portfolio, you might want to use the systematic withdrawal plan as an alternative to pull your money out gradually. The advantage from a taxation perspective is very clear. Because you're selling a part of your principal and a part of your profit when you sell, let's say you decide you're going to come out over 24 months, you're not going to pull out all of your principal first or all of your gains first and all of your principal or gains at the end. You're going to pull out in every installment. You're going to pull out some part of your principal and some part of your gain. And because you do that, it becomes very tax efficient as a method to withdraw money. People know this with loans. People know that they pay more interest at the beginning. They pay less interest at the end. But with systematic withdrawal plans, you're actually doing exactly the same thing with your market timing, and you're also making it far more tax efficient. So I'll just leave it at that, and thank you very much for your time.
Thanks for taking us through the different ways to save our pennies. I'll directly throw the questions because related to tax, there are many. So I don't want to take away any chance from them. We'll straight away jump into the questions, yeah.
So what is the best option? To repay your loan account or to have an SIPs in mutual funds?
Is it a home loan or a personal?
Home loan, yeah.
So I think, a lot of this depends on your other financial goals. The challenge is that most people look for possibly very simple answers to some of these questions, and unfortunately they're quite complex. I'll try to just explain this to you. So if you look at a home loan over a 20-year period, there's a fairly high chance that you will end up with a good investment product, let's say equity oriented, outperforming the cost of the home loan. The challenge is that most people will not have the discipline to run through this for the entire period of their loan. What will tend to happen is they will measure each year and try to look at opportunity cost. So let's say, for example, you're paying 8.5% on your home loan today. You will look at your SIP performance at the end of 1 year and say, what did I make there? So if you see a number which is less than 8.5, you will actually say, I should have paid off my loan. And guess what you'll do? You'll stop your SIP, you'll pay off your loan. The next year you will actually see that your SIP returns are 17%. Then you will kind of do exactly the opposite. So I think for people who are very disciplined, who understand what they're doing, who are truly long-term, not measuring performance every year, understanding that equities as an asset class will not be linear, unlike your home loan, I think there's an opportunity for people to do that. I think for most people, we find that paying off the loan will be better because they will not have the discipline to continue through the strategy, because there will invariably be periods where the cost of their money will be higher than the SIP.
So there are two questions. We'll come back to.
Hi, I'm Rahul Desai.
Hi.
This is regarding medical inflation. You said around 11%. That is what your slide showed. Economic Times had mentioned medical inflation as 20%, sir. My question is, can you repeat? I could not gather how and how much you should take cover.
So, first of all, let me answer the question first. The source of that 11.3% data is actually a survey done by one of the leading firms which does employment-oriented surveys, and they look at healthcare inflation across the globe. So they do India as well, along with that, and that's the source of the 11.3. Of course, I've seen numbers varying from 15, 20, 25%, but most of them are, in our view, thumb rule numbers. There isn't actual data which is available to tell you this is the inflation rate. Having said that, I think the more important part of your question was, how do you decide how much is enough? And for us, the clear view on that is that it depends on your age. As you're younger, I think what you can do is you have the ability, and when I say younger, I'm talking about all the way up to 40. You have the ability to keep expanding your medical coverage. Hopefully nothing will happen to you before you're 40. Before you turn 40, you have to start to think saying, if medical costs are going to be 8 times more in 20 years from now, then what I need to do is I need to be covered at least for that possibility that this is going to happen. And therefore you will actually end up buying much more insurance than what you can fathom today. So today for a lot of our clients, we're telling them that they need to have between 50 lakhs and 1 crore of health coverage because of the fact that this is how it works. Now, how you price it is different. So you could look at using a combination of a health cover with a super top-up or a top-up. So you can do things to bring down cost. But I think, one of the things that we are a little reluctant to tell people is, just depend on your own corpus. Because I think the mistake that people make is they look at their own corpuses and believe that through their lifetime, they will have one serious illness, which will require one hospitalization. And therefore, if they've provided for that money once in their corpus, that is enough. Yeah. The reality is that in a family, you can expect that both you and your spouse will go through something serious. Because both of you will go through something serious, you'll run the risk of having something recurring in nature as well. So you don't have to plan for one, but you might have to plan for four. And now if you have to plan for four, that's a lot of money. So you need to have adequate insurance. It needs to be looked at very, very seriously. And I think the more you can afford, the better it is.
Thank you very much.
When it comes to insurance, there has always been this doubt. Online directly, if you buy, it's cheaper. Are there any clauses, variables that one need to be worried about that, if you directly buy it vis-a-vis an agent?
So in fact, one of the things that clearly happens is insurance companies today prefer online buying from an underwriting perspective. For most people who fill in their own applications online, the chances that they will
make a mistake,
not make a mistake, but they will write something which is not right, tend to be lower. And again, I'm not trying to make any allegation or anything of that kind, but I'm just stating that, for professionals who depend on, income from that insurance policy, there might be things that they skip over, or it's just that, they are dealing with so many clients that they just, filling in the form in a very routine manner. Or they have someone in their office filling in the form for them who really has no idea about a lot of things that you're going through, which you know much better. So actually from an online perspective, we find that you're probably going to be better accepted by the insurer overall. Now this is of course life. Health insurance covers typically don't have any benefits extra if you buy them online. They pretty much work the same. There is no cost saving that you can get.
Thanks.
Yeah. Hello, my name is Sitti. So this is relating to investing in NPS for self-employed people. You told us about 20% on the income, or I did not get that point. How can we have that facility apart from the 5,000 rupees, 50,000 rupees per year we can have over and above 1.5 lakhs on 80cc?
So what most people do is that, they run their self-employed business through typically a proprietorship firm. Right? That's a very common mode that people end up using. And what ends up happening there is that if you are able to contribute 20% of your gross income to the NPS, then that portion doesn't need to be offered to tax. Clearly, I'm not a tax advisor. I'm actually a financial planner. So you should consult with your tax advisor on how to make it appear in your sheets. But I think it's an opportunity for the self-employed as well.
Thank you.
For the purpose of tax planning, is it a good idea to look at, apart from your individual investing, create a HUF for yourself if that opportunity exists? And if so, how do you actually really fund your HUF that you yourself are karta? Is there anything that we should keep in mind?
So, using entities to save tax, in our view, is on its way out. And therefore, we think that, the simpler you can keep it, the better it's going to be. Clearly, there's a tax slab available. Clearly, there's, some extent of benefits that you can take as a result of that. But the reality is that if you want to dissolve an HUF or you want to partition an HUF, which are typically your ways of closing an HUF, it's a very complex process. So I think the question really that people need to ask is that if they are, going to create it purely as a tax-saving vehicle, do they have enough bandwidth? Do they have enough time? Do they have enough resources to deal with the creation as well as the closure? Because ultimately, at some point, we think that this will change because world over, there is no concept of an HUF equivalent. For a lot of our clients who, let's say, are in the US, when you go to a US tax advisor and you tell them, like, we have like what is called an HUF, they're like, what? Is that a trust? Like, no, it's not a trust. We have a trust as well. So we think that this is, as an entity, it's going to go away. More and more of these structures are getting complicated. So if you don't have one, then I don't suggest people create one at all. So the question is that, and I'm not going to try to make it very US tax specific because of course I'm not a US tax expert, just like I'm not an Indian tax expert. But having said that, when you are a part of something, right, then you're expected to report those assets also as a part of yours. The challenge is that most HUFs will not have got reported as your asset when you're filing your US taxes. Let's say, for example, your son may not be reporting his role, his part in the HUF as a part of his taxes at all. Because he's not reporting it as a part of his taxes when it's an asset, when the money comes back to him, how does he report that this is now money coming back to him? Because it was never his at all. Now we cannot say now it is yours and it was always yours. So I think there's a lot of complexity which has come through cross-border tax as well. And therefore we're saying that some of these structures have become much more complex than what they used to be a few years ago. So think very hard before you set up that HUF.
Okay. Yeah, I'm Vishal here. Yeah. My question is, how is PPF and NPS different other than the withdrawal benefit in NPS? And my second question is, in NPS, we have Tier 1 and Tier 2.
Yes.
So what is the difference there? No, a small one is, the third one is a very small one. Can we invest full tax amount, a tax benefit amount of say 1.5 plus 0.5, 2 lakh in NPS itself?
Okay.
With the tax benefit?
So let me answer the first one, difference between PPF and NPS. So the PPF is clearly at this point in time, a guaranteed return product. The rate changes. There is apparently a rule that applies on a certain rate above the 10-year GSEC average. The reality is that rule's not getting followed right now. So if you sit and track it, you'll not be able to see the exact correlation. Having said that, it's largely debt oriented and therefore tends to be relatively more stable. On the NPS, as an underlying instrument, as an underlying investment, you can choose your mix of assets. You are allowed to buy 4 options: equities, corporate bonds, government securities, and alternative assets. 4 options available. You can choose the mix, or you can go in for what is called a life cycle option, where the mix is automatically driven by your age. Now, what tends to happen is that because you have a choice on where that money can be invested, you get the benefit of using assets which can give you longer term growth if you're younger and putting your money into the NPS. If you're probably older and using the NPS, then you get the chance to use more debt. The second thing that you can do there is you can choose your manager. So there are a bunch of underlying managers that you can choose. A lot of the well-respected financial institutions have actually bid to become NPS managers, and they manage money there. So therefore, you can actually switch once a year across managers. You can actually, look at performance. You can decide how you want to take that mix and do whatever you wish to do with it. So there's a lot of flexibility around that mix and the manager, unlike the PPF, which is one single route. The second big difference is liquidity. So on the NPS, you necessarily will have to withdraw the money, a part of it in the form of an annuity, which means that it will get created into a monthly cash flow. In a PPF, on maturity, you can actually withdraw the entire amount in a lump sum. So for people who want the lump sum back, the PPF has the advantage. It's also, as of now, tax-free. In the NPS, if you decide to withdraw before you're 60 years old, you then end up having to annuitize 80% of the money that you've put in there. If you withdraw it at 60 or you choose to withdraw it later because now you're allowed to defer it as well, then what you end up doing is you're forced to annuitize only 40% of it. 40% of it.
Annuity and 60%
20
you can
and 60% you can take out, and 40% of that amount is tax-free. 20% is actually going to be taxable of the money that you take out besides the annuity. So there's a difference on tax, there's a difference on management, there's a difference on asset classes, and there's a difference on how much you can take out at what point. Okay. So that's on the difference. The second question that you had was, can I take 1.5? Sorry, that was the third question.
Third question.
I forgot the second one because I told you I can only remember two. The third one is what I remember, and I'll ask you to repeat the second one. So you can actually do 1.5 plus 50 plus employer benefit. This is available under ATC as well, because there's an ATCCC section that you can take advantage of. If you can just repeat your second question, please.
Difference between Tier 1 and Tier 2.
Okay. So Tier 1 is essentially an account where all your tax breaks come because your money gets locked in the way that I just spoke about. In Tier 2, it's very much like a savings account or an investment account where you can put in money and withdraw it as you wish. So typically your Tier 2 is like a substitute for mutual funds, any other investments that you make. Your Tier 1 is essentially your pure retirement savings account.
Okay, thank you.